Hello and welcome to this week's edition of MindWeb.com's Gold Weekly podcast. My name is Jeff Candy and I'm here live at the Minds and Money Conference in the Business Design Centre in Islington. And joining me is Ben Davies. He's the co-founder and CEO at Hinde Capital. They're a London-based financial services provider and they run predominantly a gold fund. Ben, if we look at what's been going on macroeconomically, there's a lot of chaos in Europe at the moment, a lot of pressure being put on European leaders, particularly for the summit coming up over the next few days. A lot of concern about whether or not there will actually be a euro at the end of this or not. Clearly this has an impact on gold prices. How much of it is impacting on gold prices, or how much of this is priced into gold prices at the moment?
Well, hi, thank you very much for having me on the show. I think that's a very good question. Actually, I think people are probably quite disappointed with the way gold has been performing, and also silver, which is its cousin. Its poor cousin. It's been trading particularly poorly, and possibly that's the industrial component to the silver market. But I think gold has been part of the risk-on, risk-off trade. As dull as that sounds as an explanation, I think that's it is a reliable explanation. Clearly, the gold price, when it hit 1900, had a mini parabola, possibly. It was playing catch up with the proliferation of currency in the world, and it felt a bit overextended. And certainly there's a lot of rumour, and I certainly subscribe to it, that there was some central bank intervention in the market. We see central bank intervention in many markets, FX, so why won't we see it in the gold market? And I certainly think they did that because in order to get through some of the coordinated actions in foreign exchange, and also bailout packages like we're seeing with the EFSF, and possibly now a fiscal union, as trying to bring a cessation to the euro problems, which, by the way, long term I think the euro does have severe difficulties. I think there will be defaults, but needless to say, that put the lid on the market, and that really was a game changer, that central bank intervention, because it flushed out a lot of longs in the market. Since then, we've really witnessed credit tightening. A lot of our indicators that we look at, severe stresses in the system. There is no interbank market. Liquidity has now been provided by 5 of the central banks in a coordinated fashion, and this has gone some way to buffering the markets. But this is not a liquidity issue, this is a solvency issue, so this is only going to pave over the problems for the time being. What did that mean for the gold price? Coming round to your original question, I apologise, is that the market definitely, after that central bank intervention, exhibited some deleveraging, that risk on, risk off, and it was right across the board. There is no doubt, though, that some central banks came into the market. 148 tonnes was bought in the October period, so clearly lower prices brought in proper buying, what I call official sticky money. This is about rebalancing currency reserves, and so that was very healthy for the market. I think we're going through a mini aftershock process where the market is going to acquiesce sideways for a while. I did say early on at the start of the year, and people can go and see a speech I did back in, I believe it was September, where how we laid out through something called Benford's Law. It was a bit of fun, really, but we were suggestive that we'd get to 2,100 by February. I did try and call for it a bit earlier when it felt that we were pushing up through 1,900, but central banks put the kibosh on that. So I still think that February we are going to see those 2,100, which interestingly will be into the Chinese New Year. In fact, it actually comes a bit early. Perhaps you want to ask another question, because I've been talking for a long time. Apologise.
Not a problem at all, Ben. And I think that this risk-on, risk-off trade is an interesting dynamic, because there's almost a to and fro between that and the notion of safe haven buying. So sometimes, for example, we get a sense of gold as a safe haven, and at other times it seems to be trading as a risk asset, and it seems to go between the two of these. Has the notion of gold as a safe haven, that's the word, thank you, has the notion of gold as a safe haven almost not necessarily run its course, but now become so much part of the discussion that it's now kind of built into the market?
Look, the reasons why I'm invested in the gold market and investors, perhaps even not the pro money, I think gold is money. The way I value gold is based on money, and when I look at fiat currency and the monetary base, that to go back to what we believe is a fair value, it's not inappropriate to have a gold price of 4,500. What we're experiencing now is a resetting of gold in the financial system as a monetary asset. People talk about safe haven because they're trying to reduce liability risk. Certainly, I think that if you want to be Machiavellian, you could say that central bank intervention, in order to get coordinated action through, they didn't need the gold price shooting through 2,000 and then rocketing up to 3,000, because that would be very suggestive that the financial system was very unstable. So certainly they needed to keep the lid on it. And the reality of that situation is that, yes, some people have gone, oh, maybe gold isn't as safe as I thought. But those who really understand, and as people like myself educate more people who are not so familiar with gold and what it really means within the financial system, I think that will come to pass. People will understand the volatility in gold is actually a function of the currencies. But when you've got all currencies debating, it's just the twos and fro's between dollar, euro, won, and the gold just gets caught up in that mix.
How do you see gold's role as a monetary asset changing over the next few years then?
Well, under a fiat currency system, clearly that in order to maintain the welfare state, you want to be able to pay for services, Social Security, Medicare, for instance, in the US. Now, a fiat currency is the perfect system because you can print as much money as you like. That gets you re-elected. So you could argue that the status approach would be to maintain the fiat system. Now, what is pretty clear is that the system isn't working. Fractional reserve banking isn't working because you effectively make a zero provision weighting by buying sovereign debt and lending it out multiple times on bank balance sheets. And we're now realizing that these sovereign balance sheets are actually worthless, they're bankrupt. So the whole financial system is brought into question. So it's not inappropriate now that people are looking for an asset that has no liability, that can really store savings and be used ultimately as real capital in the system, and that is gold. And so perhaps government, it will be the last thing they want to bring back unless we have another Reagan come along who's serious potentially about bring back a gold standard. I personally don't want a gold standard because at the end of the day that's still by decree of government. Fiat means by decree of government, and a gold standard really is a fiat standard, it's just a gold standard. I believe that we should have a free market, free gold association where supply and demand decided by the free markets will ultimately determine what the price of gold is. And I think that the internet is a very powerful tool, and people underestimate that it's got a huge global consciousness out there which is now beginning to understand what is wrong with the financial system and how gold actually could be a huge stabilizer. But in order to stabilize it, we need to bring gold back to much higher prices to offset the proliferation of debt and hence credit and money that's occurred in the system over these last 40 years of this fiat currency system.
Ben, just quickly to close off with then, if we look at where we are now, particularly with Europe and coming back almost full circle, how do you see the next few weeks playing out for the Eurozone, and what is it likely to do for short-term gold prices, especially given the volatility we've seen in recent weeks?
Yeah, are we going to look back and go, this was the week that was? I'm hopeful. Clearly, Merkel and Sarkozy talking about fiscal integration, a fiscal union, which you need. You can't have monetary union without fiscal union. It doesn't work. We've seen that. But there is a sequencing event here. Now, it's interesting that the ECB president, whose name has gone out of my Draghi, sorry. He spoke last Friday, and it was a very important speech because he inferred sequencing. If they get a treaty change, if we move towards fiscal integration, then maybe we will implement some forms of monetization. We will be a backstop in the system. Do you know there was only 5% of MEPs were actually in the European Parliament to listen to that? They all came back for the gaming act afterwards, which no doubt prodded by lobbyists. It's tragic. And But I am hopeful. There is a sequence of events here because I think Mario Monti, he's a Europhile, he's a technocrat. Actually, in this case, Berlusconi's out of the equation. I think it's no coincidence they're now starting to come to some kind of agreement. I am hopeful that they will come up with the beginnings of fiscal integration. But this is only just beginning because it's going to take a lot of time for this process to pass. You need ratifications of the treaty, but it could be the start of really preventing the system imploding, because that's what we're talking about here. There is no interbank lending, and it's having a huge ramifications on Asia. There's a lot of lending out of Europe and the US into Asia, and I've just come back from a trip there, and the mood has changed. Not only are they looking at China PMIs turning down, obviously the Chinese PBOC started easing there as part of this whole process, but they're worried, and that's the first time I've seen that part of the world feel fear, even more so in some respects than I saw in 2008, and that has huge ramifications for the commodity markets and gold. And actually, in the interim, there's been a lot of selling by speculators who bought into a lot of gold ETF funds in China. So part of the sell-off we saw in recent months was actually not because they wanted out of gold, but they'd lost so much money in housing, which they'd all bought on margin, and with the macroprudential regulations come through, they've just crushed out of that market. And also the stock market's been down horrendously in Asia, so they had to liquidate.
Ben Davies is the co-founder and CEO at Hinde Capital. And that's it for this week's edition of MindWeb.com's Gold Weekly podcast. From me, Jeff Candy, thanks for listening. And please join us again next week.
Thanks very much for having me.
Thanks, Ben.